All right, welcome back, everyone. Thank you again for joining us for this breakout session 2. For this next 45 minutes, we're going to be talking about housing finance products and tools. So we learned about some of the barriers to housing finance in the past. We've got some experts on our panel for this next section that are going to be talking about some solutions to address some of those barriers and how we can collectively help as a community, folks in our residents who are maybe lower moderate income to navigate the products and programs that are out there. So we're joined by Abraham Pardo, who's the Director of Housing for the Urban League of Philadelphia. Thanks for joining us, Abraham. We have Pamela Onslinger, who's a home ownership and financial services manager at NeighborWorks Northeast of Pennsylvania. I've heard good things, Pam, so thanks for joining us. And Colleen Baumert, who's the Director of Homeownership Programs for the Pennsylvania Housing Finance Agency. So we're really happy to have all three of you join us for this panel. So just to kind of maybe set the stage again as a transition from the last discussion that we had, I'm just going to maybe kick this one and start it with you, Colleen. The greatest barriers that you might see for people who are low and modest income acquiring a home. So obviously you see this from a more statewide place and a higher level, and then we'll talk maybe more regionally with Abraham and Pam. Okay. I'm going to give you that. Okay. So that does not amplify, as everybody knows. That's for the recording. So we're just going to pass that along.
Okay. So one of the biggest barriers that I see day in, day out, we get tons of calls about how can I buy a home and I don't have any funds to buy a home. My rent is like $1,500, $1,800, so I know I can afford a home. How do I start? So we ask that borrowers first start by contacting a counseling agency. That's the first place to start. So the counseling agency can review their situation and determine if they're mortgage ready. And you may have some borrowers that think they're ready. Maybe they're on their credit. They have a credit score of 720, but they just don't have the funds, the down payment and closing costs to get into that home. That is the biggest hurdle for many buyers. And they saw on our website that we offer down payment and closing cost assistance, and how can they obtain those funds. So we tell them to go to the counseling agency, and the counseling agency would also have a partner with a PHFA lender. And then the PHFA lender and the counseling agency will work together, and then the borrower is directed to that lender. The lender would then determine if the borrower is eligible and provide them with a pre-qualification letter. And hopefully one of those products are PHFA, because we offer down payment and closing cost assistance. And I guess right now I'll just kind of talk about the down payment and closing cost assistance that we offer. The number one product that we offer is called KFIT, Keystone Forgiveness in 10. Forgiveness in 10. Oh my goodness, thank you. Yeah, KFIT. So KFIT came about because we wanted to make sure borrowers are financially fit to get into the home. So that's where the whole concept came about. And KFIT provides 5% of the lesser of the purchase price or appraised value, with no maximum dollar amount. And that's the biggest part of it, because typically since our existence of 1982, we've offered down payment and closing cost assistance, but it's always been capped at a certain amount, like $5,000, or the one that we currently had before KFIT was $6,000. But we came up with the concept of no maximum dollar amount. So it's just based on the lesser of that purchase price or appraised value of the home. So if the borrower is purchasing a home and it's like $250,000, and you take the lesser of the appraised value or purchase price, they would receive $12,500. And that $12,500 for KFIT is forgiven 10% a year over 10 years. So that's the term of the loan. And it's really been successful. We rolled it out March 2021 during COVID, and it really exceeded our expectations. In that 9 months, we helped over 2,200 families. And then looking into 2022 was the agency's record year. We had a value of over $1 billion, and we were able to double the amount of families we assisted with KFIT. So we helped like 4,300 families with KFIT funds. And the KFIT funds are utilized with a PHFA first mortgage. So the borrower that is trying to obtain that DPA from us, they have to contact one of the lenders. So they can't go to a lender that's not on our list. And one of the other things, I did talk about the counseling agencies. One of the other criteria that we added with down payment and closing cost assistance is obtaining counseling, homebuyer education. So that's one requirement that they must have. So so overall, in a nutshell, the biggest hurdle is down payment and closing cost assistance, and we have products that can assist them.
Yeah, I think we heard that with some of our earlier panel too, that there is capital and financing options for some of those and some creative ways that those are being leveraged. So thank you, Courtney. Abraham?
Yeah, if I can add something just from listening to the presentation from Andrew this morning, it sounds like you guys Scranton is dealing with some outside factors, also having a tremendous impact on the affordability of the units that are available at this time. Also, the city is growing, and obviously the infrastructure was not there for that to happen at the pace that is happening right now. So I think your current situation also calls for advocacy on a policy level. I mean, what we came to find out in Philadelphia is that we could be doing X, Y, Z, but none of that will have as much impact as if we got the support from the city, from city council, to actually make some type of commitment and look at housing as a priority. And ultimately, that's what led into the Neighborhood Preservation Initiative that is funding programs such as the Philly First Home Grant, the $10,000 grant that the city offers. Then we're about to relaunch or launch the Turn the Key program, that is a subsidized unit program. They also do some of the Tangle titled work is funded through that initiative as well. But overall, it took the work of not only housing counseling agencies, but different actors throughout the city coming together and recognizing that housing was a priority and carving a portion of the budget to make that a priority for the benefit of low and now more often, and in this case here, moderate income families as well, which is starting to be a problem.
Thank you. Pam, how about here locally?
Sure. So one thing that, I kind of describe our services as is a key to opening the door to some of these programs. As, we mentioned, PHFA really supports housing counseling by making the education a requirement to get their loan products. We also heard about PS Mortgages program. That's funded through First Front Door. And a lot of banks in our area are approved for that program and underutilize it. It's a $5,000 match. And the interesting thing with all these different programs is some of them play nice together and some of them don't. PHFA, they don't want to see additional down payment assistance programs. They, have a little bit of restriction around the type of layering you can do. And for reasons. You can't overextend a home by over-leaning it. And a lot of these down payment assistance programs are second and third liens. So that's another thing that you have to kind of think about. The First Front Door program isn't a lien. So it does play nice with some of these other programs, and we can combine them. And the nice thing with that also is First Front Door has 80% area median income restrictions. Some other programs have higher income. The Lackawanna County program that we currently administer is 100% area median income. So, we also run the City of Scranton program, which has a different income restriction. So when we meet with people, we're not just looking at them as, an opportunity to educate them, but also to provide them the access to these different funding sources and the tools to be able to combine and maximize the impact of them. When we look at KFIT, we are huge supporters because they have some of the highest income limits. Mm-hmm. So, sometimes people come to us and they don't think that they can qualify for anything. They're simply coming to us because they want the education, because they're scared. At the end of the day, the buyers today are the children that went through the recession, and they are terrified of sitting down with a lender and being taken advantage of, or not understanding what they're talking about. So a lot of times people think, the clients we serve are just low to moderate income. They're the ones that we have some of the biggest impact with because we're able to connect them with resources to be able to purchase. But we also work with anyone that simply just wants to know and be empowered to be able to make the right financial decision for themselves and not be intimidated going into it. But when I think about some of the greatest barriers for low to moderate income earners, it really is the financial capabilities, the financial standing. When you look at somebody who has a restricted income, they are more commonly going to have lower credit scores, higher collections, and then also demographically speaking, they're your underserved communities, they're your minorities, because their incomes aren't as high. And so when a lender is evaluating someone, those factors all inadvertently come into play. So one thing I wanted to mention is a situation that arose during 2020 is we had low interest rates and everyone flocked to the banks to either buy a home or refinance their homes. In June of 2020, we had several low to moderate income earners that were approved for FHA loans. And in that month, the guidelines changed and went from being a minimum credit score of a 580 to a 640. We had several people that were pre-approved, approved for our down payment assistance program, and got the door shut on them, literally. And they weren't able to purchase. They came back to us as financial capability clients to try to figure out how to resolve their debt to income ratio, how to resolve some of the collections that FHA said, yeah, we can approve you, but now we can't. So now we do need to address those things to get the credit scores up. So at the end of the day, I think some of the biggest barriers is really access to, being able to meet the requirements that are set by the lenders.
Yeah, I think, Pam, in some ways, and I know in our organization, one of our focuses is meeting people where they are. Chris mentioned it multiple times in his presentation, and I know Leslie, a lot of the focus in Philadelphia was around that too. So like, how do we find what people really need and try to provide that service? I think right now what we're seeing also in the industry as a whole is, as we're seeing people who are coming in, student debt and just debt overall is pretty crushing to a generation of prospective buyers. I think we saw some stats that it was statewide, but even locally, that the average age of a first-time home buyer has increased by at least 2 or 3 years, which doesn't seem like a lot, but that's a significant shift. If somebody's buying, if the last generation was buying their first home at 27 and now it's 31 or 32, there's a whole lot of ripple effects of that, right? And student debt and some other debt have certainly, we've heard, play a role in that. But I'd love to hear the perspectives. We'll start with you, Pam, just from a counseling standpoint in terms of what you're seeing and what types of things that can be done about helping people resolve debt or figure out ways to work around that so that they can still build assets while dealing with debt.
So student loans in particular wasn't really something that we had expertise in until the last couple years because it became a growing issue. So the one thing to be cognizant of is the underwriting guidelines. If someone is in a deferment or not making payments or on an income-driven repayment plan, which is very common, if their payment on the credit report is not considered substantial, which means if you're accruing $100 a month in interest, but your payment's $50, you're never actually putting anything towards the principal balance of the student loans. So what ends up happening is you trigger an auto calculation of 1% of the total debt to be used as the debt against your income. So when a lender does that, if you have $80,000 in student loan debt, your payment's calculated to $800. At the 1%. So a couple of tools that we use with clients is to, one, see if they can get into a repayment plan that is qualified, so that way the lender doesn't have to do the 1%. Also, if your student loans are government funded, you can log on to your website and there's a mortgage verification form. It's populated based on your interest rates and your debt, and it'll produce the actual mortgage number that you would have to pay if you were to start repayment right now. And underwriting guidelines will accept that in place of the 1% calculation, and sometimes that number is less than the 1%. The other thing is also looking at your employment. So if you work for an employer that you can get approved for the Public Student Loan Forgiveness Program, Freddie Mac will actually calculate your debt-to-income ratio at 0.5%. So what that means is if you go to a lender that underwrites through Freddie Mac guidelines, and you show them, hey, I'm pre-approved for the Public Student Loan Forgiveness Program, here's my letter from the government saying I'm approved, they will do the calculation at 0.5% instead of the 1%. And then for those people that don't fall into any of those buckets, we have to have a very gentle conversation about debt obligations and PTI and how it, unfortunately, those are all the tools that I know of.
How about Abraham?
I think you raise a very important issue, which is a lot of what we're having to deal with, or what we identify as housing counselors, sometimes took place 10 years ago, 20 years ago. I mean, when some of these under-resourced clients were preyed upon for certain kinds of products and services that they didn't understand, and therefore now they're trying to buy a house, but that repossession on the credit report is not looking so good for a lender. To your point, yes, understanding how lenders and investors look at this, understanding that they have different products and services, that's always something that we talk about with our clients, different lenders, different overlays, different situations. What is true for one lender may not be true for another lender. But also very important, educating consumers about how debt works. Most likely, if you lived in a household where your parents had a credit card, then chances are that you know to some extent how to use a credit card. If you grew up in a house where your parents had a mortgage then, or if someone you knew had a mortgage, then you know how that works. But what about those folks who are doing that for the first time? Right, they're confining and relying on the housing counseling agencies, neutral territory, to help with those types of situations. Right, I've met personally with folks who have very promising careers ahead of them. People who are already on the $80,000, $90,000, $100,000 income brackets, and just looking at what they went to school for, I'm like, oh my God, in your career you're going to be making a lot more money. But here they are sitting in front of me because they're the first person in their family who's about to buy a house, and they're very afraid of asking those questions, like how does a mortgage work? That's really as simple as that. I jokingly say we're going to help you crack the code of how this works. It's very simple math, right? But it's very unknown to some of them because no one in their family has ever experienced any of that. Which some people can be very afraid of disclosing. Housing insecurities is a complicated topic to address for some folks.
Yeah, I think that education piece, we've seen that especially over the last decade. You know, Pam mentioned the kind of Great Recession. You know, I started in this role right after the foreclosure crisis kicked off in 2007, 2008, and I just remember, you know, we shifted from first-time homebuyer counseling and pre-purchase counseling to foreclosure prevention, you know, in a matter of months because of the need. And I think it's interesting because we're seeing the results of that in terms of the next generation of buyers who grew up with that or remember that time, and really it's a barrier for them because they saw a family member lose a house or get foreclosed on. It might have happened in their own family, and even if they have the income, even if they have great products, you know, from PHFA and others, there's still something holding them back because of that experience. And you know, I think it's the education piece and even the outreach piece and communicating is so much more important now because of that. Right?
Addressing the trauma is the word that is being used. We observed some behaviors from the folks who had purchased a home through our program. That we noticed that life is going to happen, right? So ultimately, sometimes people fall 1-2 payments behind. And we noticed that these folks, often these families will get stressed very quickly. and we couldn't immediately identify why that was. I mean, for those of you who are familiar with how the foreclosure process works in Pennsylvania, it's going to take a while for someone to get foreclosed on. I mean, there are many locks in places precisely because of the last recession and because how the system works, right? But these folks were coming from experiencing housing insecurity at a renter's level. Where the type of situation, the 5-minute eviction, right? So there was a lot of trauma that came with that as well. So it's important to acknowledge that.
Yeah, definitely. I think in Pennsylvania, we do have the benefit of a kind of vast housing counseling network. Pennsylvania Housing Finance Agency is truly a national leader in creating the structure for housing counseling and credit repair, pre-purchase counseling, financial stability. Many of our colleagues across the country are always jealous of us when we say we're from Pennsylvania because of the support that we get in the structure that exists under PHFA's leadership. But it's always still doesn't feel like enough, I think, is kind of what we feel on the front lines because the challenges are pretty substantial for folks. And so, Colleen, from PHFA's standpoint, in terms of when we look at debt as an obstacle, how does that play into K-FIT and some of the other products that might be available? Are you seeing kind of that debt, student loan debt, and other types of debt still being a significant barrier, or is that something that you've seen people been able to work through?
It's definitely a barrier. So on the PHFA side, we would be considered the investor. So we would have certain guidelines that we would follow. If it's a conventional loan, we would follow Fannie Mae's guidelines. So Pam shared about the 1%. So if the student loans are deferred, they're going to pay that 1%, and then that would be added to the ratios. And the debt to income maximum for conventional loans on PHFA side, she shared that there's other investors that have other guidelines, but on PHFA side, our max DTI would be 50%. So that would be 50% for conventional financing, and borrowers would need to have a minimum FICO score of 660. So 660 is the minimum. And you shared that some folks go down to 580. PHFA really values homebuyer education. So if we get a call from a borrower and they have a score of 580, we're referring them to a counseling agency so they can work with the counselor in building their credit. And when it hits the threshold of 660, they can come back and apply for a home. Because we talked about foreclosure. The last thing that we want to do is provide someone with a mortgage and foreclose on them a year later. So we would refer them to counseling. When we're looking at government loans, FHA, VA, rural development loans, the threshold, the maximum DTI is 45%. 50 is conventional, 45 for government loans. And again, we may see borrowers that are over, like a lender may qualify a borrower for FHA loan, and they're over 45%. They send it to PHFA. Our threshold is 45.00. We can't go over that at all. So we would go back to the lender and then provide them with another option. The borrower can go conventional. But again, they might have student loan debt, and that might be a barrier for them. So we may encourage the lender to rework the loan. Maybe there's small debt the borrower can pay off to fit the criteria of a conventional loan. So we do have some options, but the debt to incomes are set as well as the FICO score.
So maybe one more question around barriers, and then we'll flip the script a little bit. But this has come up multiple times already today. I know Mike mentioned it, and some others as well. The market itself, meaning the housing supply. So we can have the best products in the world, and all the folks who are ready to go, they go through housing counseling, they've got their credit score up, they do all the things that they need to do. if there's no house to buy in their price range, or they're getting outbid every time by cash buyers, then we still have an issue. I think one of the things that's kind of on our mind, and I think collectively in this community should be more on our mind, is we're celebrating the advancements in the Amtrak rail project, creating high-speed rail from Scranton to New York City metro area. But what if that comes in 4 or 5 years, like we're talking about, how are we going to be ready for that? I mean, we're looking at our neighborhoods right now. We're looking at the issues we're facing right now, and we haven't even opened that door yet, right? But we'd be foolish to think the investors from that area aren't already here, making cash offers on these properties because of reasons like that. So, I'm not saying we're going to answer that, but I want to maybe dive into that issue a little bit on the supply side, and even talking to Abraham and Colleen about what you've seen. Well, I'll give it to Pam first, because she's the local expert. But this isn't a new issue, for other urban areas. It's new to us in some ways, as Andrew mentioned earlier. Those price jumps are things that we have not seen before in our region, and so we have to kind of figure that out and what ways to respond to that. So Pam, what are you seeing on that issue?
I think it's definitely an issue because we do have some great programs and products that are out there between the down payment assistance programs, things loans like PHFA, and a lot of our borrowers or our clients have trouble finding homes because they're not competitive. There's sometimes additional inspection criterias, or somebody hears, that somebody might be getting funds from a support program and they get nervous about it. So, when I think about the inventory factor, it really comes down to the fact that it's expensive to build. And then the values aren't always there. When we look at the average purchase medium that was shown earlier today, we're an affordable market. We have a living wage. There's a lot of barriers to accessing those, affordable markets. But at the end of the day, in a lot of cases, it's cheaper to own than to rent in some cases. So how do we protect that while develop it? And, that's, I think, everybody's concern. Personally, I would say, private and public investment. When you look at a new development and it's going to cost hundreds of thousands of dollars, but you want to ensure that it's able to be sold to someone who's low to moderate, grants and government development money is the supplement. It's, the difference. If you want to be able to sell it for less than you're building it, you need to have something investing in it that's not going to tie up the sale, that's going to cause a deficit in the development. Investors have to make money too. And I think, government funds are a way to supplement some of that work to ensure that we're protecting the local market, and also encouraging homeowners that aren't just going to get pushed out by people coming in with larger salaries. And I'll just call that out. Everybody was talking about, why did our housing increase astronomically in 2 years? Well, remote work, and we're 2 hours from everything. We had people move here from major cities making major money, and we're able to push out all the local, income earners that don't make the same kind of pay. And then what do we see? A 17% increase in Lackawanna County alone.
Abraham?
Yeah, I'm going to say this because Colleen is not going to say this. Regulation. You're with the state finance agency, so I'll leave you out of this. Regulation. Ultimately, this situation that you guys are going through is not new to Philadelphia. For example, when Philadelphia started to offer the $10,000 grant, when all of a sudden I was counseling a lot of New Yorkers looking to move to Philadelphia, and all of a sudden Philadelphia was, I can do a 2-hour commute, right? Which is still happening. The other item is the city, in an effort to reorganize and revamp some neighborhoods, and also get a trade-off in terms of taxes and infrastructure. They created a 10-year tax abatement, which produced a call for a lot of out of town investors that all of a sudden were like, yeah, Philadelphia, right? That's always been my neighborhood, right? That's always been my city. So regulation, particularly, I mean, there was talk earlier about higher density units and zoning, etc. But also very important if some of these developers are leveraging subsidies and state, federal, city subsidies, and make sure that some of those units are sold to people with incomes with below a certain threshold. What threshold is that going to be? Then well, that also calls for an affordability analysis, and you guys probably you organizations like yours should be able to provide some kind of input for that as well.
I completely agree with them both. Just yesterday, we had a board meeting at PHFA, and that was the number one thing that I mentioned with my presentation, the lack of inventory. Like, I talk to lenders every day, and I think this gentleman here, he mentioned, you're a realtor, right? So you mentioned about 20 bids on one home. We get those calls all the time from the lenders. And it's really hard for us. Like, there isn't anything we, PHFA, can do about that. But building more homes would be great. New construction, manufactured homes is another option. MH, that's really big, especially in the conventional world. But where is it going to be placed? And the capital to fund all that as well is difficult to find. So.
The other, if I can add to that, you just said something very important. The other term that is being thrown around recently more than manufactured is modular homes. So homes that are being built offsite. I actually talked to a company, Modular, that is not that far from here. Yeah, I'm sure there are like many of them. Yeah, right. Yeah, yeah. They're like, yeah, we'll ship a house to your neighborhood. I'm like, great. We need many of those, right? So unfortunately in Philadelphia, and that's what some of them are running into, it does not make a lot of sense, because if you have been to Philadelphia is very dense, right? So you get a site, and it might be a tiny site, so it's going to have to be a very custom house, and they were like, yeah, no, we can make that work. But in open spaces like this one, it should work, right? So making sure that those options are contemplated for markets like this, of course.
Yeah, I think we've seen, even heard earlier today that, the when you think of Scranton as a city, and even the valley here that we're in, it's built out, as we say, but it's still mostly single family detached, so our built out, it might be very different from a dense Philadelphia built out, right? So, but what does that mean, right? I think those are the types of things that we have to think about as a community, right? So, Lena, you want to jump in?
I just have, and it's something because I know you guys touched a little bit on the housing stock in the area.
Do you want to introduce yourself just so everybody knows?
I'm sorry. So hi, I'm Selena Antioch, and I'm the redevelopment specialist with the city of Scranton. We work a lot with Pam and Jesse. They do a lot of great work with us when it comes to housing development, housing ownership, all of that in the city. So I just wanted to touch on the housing stock in the city. We have a very old housing stock. And they do a great work when it comes to the home ownership dollars and getting people to the point where they can buy a home. But a lot of the issues that we also see is once somebody buys a home in Scranton, we have a lot of them that need a lot of work. And I don't know personally of a lot of programs that are out there that are coupled with a home buying program to go right into a rehab program that, again, doesn't go into a lot more red tape.
We're like struggling.
Yeah,
to get this one.
They're fighting over the mic.
Well, I can talk about our products if you want to go into yours.
Yeah. So what I would say is you hit a great need, and this is an area that I'm kind of is a little bit of a pet project and focus of mine. We have on average 100 people a year purchase homes after receiving our education. And of those, they've bought homes at 97, 95% financing, there's zero equity, and the hot water heater breaks. We also do foreclosure intervention work. I can tell you right now that my most common foreclosure client is somebody who bought a home within the last 5 years, took on more debt because they have a new shiny toy called their home, and they want to give it paint and carpet and curtains, and then something happened, whether it's the snow tires or the transmission, health crisis. So at the end of the day, rehab and programs that can go to new homeowners that are very vulnerable to instability. At the same time, not only are you rehabbing, but you're also affecting their cost of living. When you have a more efficient hot water heater or furnace or roof or windows, the byproduct is lower utility bills. And when you lower the monthly reoccurring costs, you're able to open up discretionary income that can go towards those buffers and those things that you need to plan for. When I work with clients, I tell them, if you Google an emergency savings plan, it's an astronomical number. It's really scary too. You're going to add up all of your monthly expenses. You're going to times it by like 6 months. You're going to judge yourself so hard, and you're going to be like, I'm never going to do this. So what I jokingly say, because once somebody starts saving, it's a little bit easier to keep that momentum. So I say, if your car lost control and ran into your other car, your husband's car, and that one went soaring into your house, and you had to pay your $500 deductible, your $500 deductible, and your $1,000 deductible, can you? And that's where you want to start, and then go from there. Because if you have insurance and you can't even access it, you're not setting yourself up for success. So. And PHFA also has some really great products.
Thank you for that cue. We actually have 3 programs that could help. So you talked about a borrower purchasing a home, and maybe they need new windows, they need new roof, new furnace, they want to upgrade their bathroom and kitchen. They can do that in the same transaction. We have a product called Purchase and Improvement. So it's you purchase the home and you improve it at the same time. And under our bond program, which is our flagship product, they can receive up to $15,000. And we've had that program for a very long time. But the problem that we've heard from the lenders is that $15,000 isn't enough.
Yeah.
You do a roof and maybe, I don't know, a couple of windows, half of a window in Philadelphia. So when we developed K-Flex, we have K-Flex with K-Fit. K-Flex stands for Keystone Flex, and that's a product that we rolled out April 4th of last year. We have a purchase and improvement piece, and it's $30,000. Mm-hmm. So they can purchase the house, get up to $30,000 to make improvements, plus receive the K-Fit funds for down payment and closing cost assistance.
Is that like a second mortgage, or what is it?
Good question, Jesse. Those funds are rolled into the loan amount. Okay. So it's not going to, it's going to be a part of their mortgage payment. It's not going to be a second lien. So we have those 2 products, and then so that's with the purchase. But if you have someone that already purchased their home and maybe a year or 2 later they want to come back and upgrade their home, we have HELP, which is the HEELP, which is homeowners
energy efficiency loan program.
Thank you. Yes. Yeah. They can receive up to $10,000, and it's a 1% loan. But there's an income limit of 80% AMI, and that's heavily used as well.
If I can add, it's only for windows, roof,
Energy
doors,
efficient.
Yep.
Anything energy efficiency.
Yep, and right in their name, energy efficient. So new roofs, windows. Yeah.
So one thing that we've seen, over the years, especially in communities like ours, it was mentioned multiple times about our older housing stock, and especially in the city of Scranton, the need for home repair is tremendous, right? So we're trying to create opportunities for home ownership, but we're also trying to preserve home ownership as a tool in our community, in our neighborhoods. So you have to preserve the homes that people are in now, so that there's something for people to move into that they can afford, right? And so these are some great tools that kind of marry those things. But on the other side, we've had tremendous challenges, frankly, with trying to do home repair at scale. because of restrictions in federal funding. Like, we can just say it. There's nobody from HUD in the room, so we can say it. I mean, HUD makes it really, really challenging to use their resources to fix a home. That's why we got out of the business. The city of Scranton is kind of back because it's so expensive, so difficult. Unfortunately, it's the best money too. I mean, there's a lot of resources out there, but it's very difficult to do. The whole home repair program, which has been launched this year, is a great opportunity, I think, to kind of get around some of those barriers, and we're really excited. We've kicked off that work here in northeastern Pennsylvania, and I'm sure our colleagues are seeing, hopefully how that money gets out on the street as well. So we continue.
No one from PHCC in the room.
Yeah.
No, yeah, we actually provided support and comment for, it was Senator Nikhil Sabal who pushed that initiative forward in the state of Pennsylvania, and then we when they presented it to us, we were like, what's there to sign up for? Like, we're on. I mean, let's push for this. I mean, this is a great initiative. I'm going to add to that and say also that piece contemplates landlords as well. There is a component for landlords who are good landlords and agree to continue being good landlords, so they can get some money forgiven if they use those resources. Home repairs. I mean, Philadelphia is not much different from Scranton. I mean, everything is old. I think that's why I jokingly am saying that's part of a problem with whenever there's a new project, instead of refurbishing stuff, they just knock it down and they're like. Yeah, and also on top of that, you get a tax abatement. Why not? I mean, what is the incentive of really refurbishing the unit? It makes it more marketable if you just raise it and build something new. But we're excited about that. There's another local program. You might have a similar component here in this county, the Basic System Repairs Program, which provides free, quote-unquote, support for families who are dealing with issues related to basic systems failure. And then there is another program I also administer to PHCC that provides loans for families who are trying to complete repairs. And I can tell you that even with all of those elements out there, that's still not enough. Yeah. I mean, there is yesterday, and Leslie was there in the room. We were meeting with Citizens Bank and one of our other peers from Clarify. He waited. That was not what the session was for, but he waited for the right moment to say, "Hey, Citizens Bank, what are you going to do about home repairs and loans for people who are dealing with home repairs?" And they were like, "Yeah, we have our home equity line of credit." I mean, they answer it the way a lender is going to answer that type of question. Just like, they have to go through the process, right? But what about when there is no equity in there, which is the main issue that you just mentioned? So it's an ongoing conversation.
Yeah.
One thing I'll just add to that that we kind of touched on is the governmental regulations. It's fortunate that we have programs like whole home repair coming out that is less restrictive, but I think also we have to be cognizant of old habits die hard. And sometimes when we get this funding, we often pigeonhole it along with regulations that we're already accustomed to, or we have something new and we don't know what to do with it. So one thing that is coming out of some of the funding is this money is getting to the county level, and they're choosing not to include the piece around workforce development, not putting the funding towards labor and training programs, and because they don't know how. That's really what it comes down to. They're choosing not to incorporate the landlord piece because they don't know how. And we end up creating, that barrier that we were getting rid of in the process. So some of it is governmental imposed, some of it's self-imposed. And we have to be aware of that when we're looking at these funding sources and how regulations also change over time. Something might have come out in the 60s and the 70s, and it's been revised in the 90s and the 2000s, and people don't know that some of these restrictions aren't there anymore, because we have to be able to look at it and really think of creative and new ways to approach information.
Well, I hate to stop our conversation there, but I know we are at time. I think a couple of final thoughts. Some of the tools that we're using to preserve home ownership, whole home repair, and others. Those right now that was funded with ARPA funds. So there needs to be a push to continue to fund those alternatives to to federal home and CDBG resources going to home repair that aren't as effective. I think of other support that organizations use, like the Neighborhood Assistance Program, and there's contributors who make that happen, that are creative ways to put funding in. FAIR, which is offered by PHFA, really bridges a lot of gaps on home ownership and home repair. So, to preserve home ownership. So there's lots of other tools out there, and community support is really important in that, and just understanding how those pieces fit. The last thing I want to just share with the room is, our goal is to take all of this information and do something with it. That's why we're all here. So we're really looking forward to that part of the day. We're grateful for the opportunity not to just talk around an issue or admire the problem, as some people would say, but to actually do something with it. And we hope that doesn't end today, frankly. I think we're going to have some time to fill out the information you see to my left here. But we're hoping, and I've already mentioned this to Scranton Area Foundation, and we hope City of Scranton and the Federal Reserve would agree to this, to host something else similar to this in the fall, so that there's an opportunity to have some accountability for our community to say, if there's things that we said we want to do based on the problems and the expert input that we receive from folks from outside our region, we want to be able to do something with it and actually have some actionable items that we can work from, and then come back and say, how did we do? Because that's how we move things forward. And I think, just from where I sit, again, I've been doing this work for a while. It's one of the first times I think all of these, all of these pieces are coming together. We've got community banks who are at the table. We've got the city who's leading the charge. Federal Reserve, has been a fantastic partner. And the Scranton Area Foundation as a convener, and neighborhood organizations like ours who want to help implement it. But we're really grateful for Colleen, Abraham, and Pam for your time, your input. Can we give them a hand, please?